What's up, everybody? It is Saturday, August 6th, around 7 p.m. Eastern Time. Time for a market analysis video. I have completed my move for the most part, so still have some boxes to unpack, but yeah, in a new place, so that's exciting. Most of that stress is dealt with, so back to the markets. So in the time that since my last video, so a lot of interesting data came out and some interesting moves in the market. So we saw consumer confidence data come out that was strong. GDP numbers for second quarter and revisions to first quarter for 2016 come in that were poor. And then jobs data on Friday, which was very strong, which actually led to this breakout. So it was interesting because you saw this kind of attempt at a breakout to the downside on the GDP numbers, and then a really big jump up in the markets on Friday for the jobs numbers. And in the middle of that, Bank of England cuts rates, does QE, so which I don't know. For the most part, I believe that was expected. It wasn't expected how much they would do, and they went full bore. So the dollar catching some strength off of that after failing a little bit. So if we look at the UUP here, so it looked like it was breaking out of this little wedge pattern here, broke out, went down off of GDP, all different kinds of data here, and then back up off of jobs numbers, and then QE. So what the Fed will do in September is still a bit of a mystery because jobs data was strong, but GDP numbers were not. And so the September meeting, it'll be interesting to see what kind of guidance they give and what kind of data will come out between now and then. So obviously looking at things from a fundamental side, very interesting. My read on this is that I don't necessarily believe this breakout, similar to the breakout to the downside. It was on a Friday off of jobs numbers. The dollar did go higher, so a lot of times these jobs numbers, this move is faded over the next week. So we will have to see whether that happens, although I will say from a technical point of view, when you get this kind of flag setup or this tight setup where volatility is decreasing, and then you get a failed breakout to one side, and then a breakout to the other, from a purely technical point of view, that is a strong indication that breakout is real. You often get a fake breakout to the one side, and then a breakout, the true breakout following. However, so from a technical point of view, just looking at the price action, it looks good. From a seasonality perspective, we're heading into August, and I wouldn't. August, September, generally on the weaker side, before the end of September, and October, November, December, which are generally the highlights of the market. This is an election year, so we can see that come in. I wouldn't be surprised if that would be a late stoking of the economy. The way I read the job numbers, the fundamental data, is that job numbers are generally lagging, which is to say, after a company has had a good quarter or a good year and they have plans to expand, they hire people. So it's a response to good jobs or good results. So jobs will always follow good results. So it's a lagging. The GDP numbers obviously on point, like not a lagging indicator. And the consumer confidence, I would say, is also a lagging indicator because once people get the money, once they get the job, they spend the money. So consumer spending, consumer confidence are also lagging. So the GDP numbers I tend to believe more than the jobs. Not saying that they're not strong, but I think it's indicative of past performance, not necessarily current performance. So looking at that, when you see job numbers rise, GDP numbers fall, to me that is indicative of possibly a peak in the market, in the economy. So we'll have to watch that closely. I still, as I have been talking about in my videos previously, I saw maybe a rounding top coming with a decline. That hasn't happened. Obviously, we got that false breakout and then going higher. So I've been wrong so far. It'll be interesting to see if we do continue from here. If there is some follow through in the next week, I think we have to think that we get another leg higher before possibly a pullback. I still think there's a pullback coming before the end of year rally, but you just have to keep watching. It's very interesting to see where we go from here in the S&P markets. Obviously, with this idea of negative interest rates, the economy can flag or peak and start to roll over, and the stock market could still go higher if the Fed continues to be accommodative. That will work until it stops, and when it stops, it's really going to stop. That's my opinion. Looking at gold, so we obviously got a huge gap down off of the off of the jobs numbers. It'll be interesting to see where that where we go from here. Like I said, obviously, a lot of the jobs data is tied to the Fed and Fed expectations. So looking at this, we have a lot of support at this 126, 127, 125 area, which continues to be support. We are going to be entering that. We had resistance obviously at this 131 area, so it'll be interesting to see where the gold goes from here. I think the dollar is the strongest of the majors, and so that is a detriment to gold in general. But I think all major currencies are headed towards very easy monetary policy, and so real assets are going, I would think, will continue to do well. So I don't see a precipitous drop in gold, and I do see it going higher over the long term. Looking at oil has had a major decline, broke past that $45 a barrel, continued downward, deep correction. I still see it as being constructive in the long term. I think this was the ultimate low here back in February of this year. However, it is getting beaten down, and if the economy were to go lower, that would obviously be a bearish signal for oil. However, I think the OPEC would decrease production at that point. I think they're happy with around $50 a barrel. So I think this would be the low. I think this is the low for oil in the medium to long term. But it's going to take some doing to get this thing moving. This could be wave 2. So this could be a wave 1, a wave 2, and we could be entering a wave 3. We'll have to see. There has to be some catalyst for that to happen. Obviously, the wave 1, 2, 3, that's Elliott wave principle, which can be helpful in determining where we are. But it's generally, fuels, in my opinion, fueled by data. So looking at that, some strategies to look up. I'll continue to be posting them. I think Coca-Cola triggered, so I'll have to look into that. Although this looks like a bear flag to me, I'd have to look at the data. There is a possibility of a gap fill here for Coca-Cola, but we live in interesting times, and so there's lots of money to be made in currencies. I'm definitely would be long the dollar versus other currencies and long gold versus the dollar. So that type of trade I think has a lot of potential. And keep watching the markets. I think there's limited downside because of the Fed right now. We'll see if that pans out. So with all that being said, God bless. Good luck. Great trading.